focus. Ideate, innovate, enable. KPMG and CNBC-TV18 present Budget 2023, the fine print.
Hello and welcome to KPMG and CNBC-TV18 present Budget 2023, the fine print. I'm your host Gautam Srinivasan, and joining me to decode some of the key points on tax, investments and business of this last budget before the general elections next year are two top voices from KPMG in India. Rajiv Dimri, national head of the tax vertical, is with us, and so is Vivek Gupta, partner and national head for the M&A and private equity tax practice. Gentlemen, great to have you on board and looking forward to decoding the budget. Rajiv, budget, I guess, that focused on stability on many fronts, including taxation, considering we didn't see any new taxes being announced. Your initial thoughts on this budget from a taxation perspective and the impact that you see on capital flows?
Thank you, Gautam. Yes, you're right. Stability is a very important aspect that investors look for. Stability and continuity of policy. Nobody likes, too many changes, and because otherwise their ability to do long-term planning gets impacted. As it comes to no new taxes, I think that's a great aspect of this budget. And actually, if you look at the tax collection that have come in this year, where the targets have been met and exceeded, there was actually no expectation, and if I might add, no justification for no new taxes. But the fact that there are no new taxes is a great start for the economy, and particularly for capital flows, which of course Vivek will cover in more detail. But yes, your point is absolutely right. The first great point of the budget is no new taxes.
Absolutely. And that's music to the ears of the general population. But let's extend the conversation to look at what's happening with the startup ecosystem. Vivek, the budget has proposed to extend the tax holiday offered to startups under the Startup India scheme, and also the tax incentives will be applicable on startups in the first 10 years of incorporation. That's up from 7 years earlier. So how much of an impact will these latest measures have on the Indian startup ecosystem?
So look, the government very clearly supports the startup universe. Even the angel tax, in a sense, does not apply to startups, and that is positive. So these two changes specifically, the fact that startups can now be incorporated later, registered later, and they will continue to get the tax benefits, and the fact that they will now be allowed carry forward of losses, even in respect of substantial change of shareholding now for a period of 10 years instead of 7 years, up by 3 years, are certainly positive for the startup ecosystem. I think the government recognizes the role that startups have played in getting foreign investing flows from the largest VCs around the world, and the government intends to continue to support the entire startup universe. So both these measures that you outlined, hugely positive for the startup universe.
All right, Rajiv, there is no change in the ESOP measures either. That's a long-standing ask of the Indian startup ecosystem. Measures to curb the flipping of startups, which was mentioned in the economic survey, have also not been brought about. So what's your take on this?
So certainly there is no change, any change in the ESOP. There is absolutely no change that's taking place there. But when it comes to flipping of structures, I think, and maybe Vivek can cover this in more detail, but flipping of structures, which is something that we would want, this angel tax expansion may come in the way on that. And perhaps, Vivek, you can pick it up from here.
Yeah, sure. So look, the economic survey very clearly outlined, Gautam, the fact that the government wants companies that were earlier externalized to now headquarter back into India. Effectively, this means that the bunch of companies that were registered, let's say, out of Singapore or Mauritius or US, which have some portion of Indian business as well, or derive significant value from India, the government has been sort of pushing them to say, you must come back into India and you must place your incorporation. The place of incorporation must become India again. We saw one of the largest such companies in the startup universe actually come back into India, albeit after paying significant taxes. And therefore, it was one of the demands of the industry that the government looks at this as a policy measure. The fact that these companies come back into India and what you call the reverse flip back into India will be positive for the Indian ecosystem. When these companies list, it will add a greater depth to the Indian capital markets, and therefore it will be all around positive. And hence, to aid the shift or to assist in the shift, the government looks at some specific measures to avoid some of the capital gains taxes, not avoid them, but perhaps defer them to the point of actual sale. That was the intent of the industry, and I think there were some representations made to the government on that count. The economic survey very clearly recognized one day before the budget that that there was a need, that there was an economic need for the government to assist in this movement. Yet the budget did not have any specific provision which would have helped assist the reverse flip. What I believe is the government is very open, and this is based conversation with the government. The government is very open to considering this in more detail and to seeing what specifically needs to be done, and maybe looking at deferral of capital gains tax on any such move to the point of actual sale is what the government really needs to do, because what that can do is the bunch of companies that had externalized in the 2010 to 2014 era can then find a good way of moving back to their home country, moving back to India, and then accessing the Indian capital markets or Indian sources of financing rather than relying on overseas listings and so on. So that's where I think reverse flip stands. One would have loved to see something in the budget, but it's still very positive in the sense that the economic survey recognizes the need for reverse flips to happen, and the government seems to be open to considering what really needs to be done in order to facilitate the process of reverse flip.
All right. There's always room for improvement, but there's also a big reason to cheer, Vivek, considering more than 39,000 compliances have been reduced and more than 3,400 legal provisions which had criminal implications, they've been decriminalized. So broadly looking at things, how do you see this impacting the ease of doing business here in the country?
If we are looking at the China plus one manufacturing strategy, if we are looking for more large businesses to actually establish themselves in India, we have to remove what we call the friction between business and government in terms of operating businesses. If you look at some countries, Vietnam, other countries which are trying to access the whole manufacturing move away from China, what we are seeing is that they're offering things like single window clearances, they're offering things like business treated economically rather than criminally per se, or business infractions treated economically rather than criminally, and so on and so forth. It is very heartening to note that this government has been moving up the ease of doing business rankings for the country. It is heartening to note that this government sees the need for this friction to go away. And I think the central government is doing all that it can such that this friction goes away. Now, in a federal polity like ours, it's always interesting to see, or it's always necessary that apart from what the central government does, the state governments also follow suit. The central government has instituted measures to see ease of doing business ranking for states, or attractiveness of states index for businesses, and so on and so forth. And I would imagine that this is a continuous journey. Certainly, removing compliances and decriminalizing offenses that are either inadvertent or largely economic in nature is hugely positive. I think not only hugely positive, it's actually necessary if we are to remain competitive insofar as attracting investments is concerned. This is a time when capital across the world is at a premium. If we have to attract our fair share of capital, and more than our fair share of capital, it's absolutely imperative that ease of doing business be focused on. And the fact that the finance minister mentions this as an important constituent of what the government wants to do is indeed heartening.
Absolutely. And it'll be interesting to see how India fits into the global investment equations, considering it is an attractive destination from an economic perspective. But as you mentioned, where capital is at a premium, so the government will also need to take steps to make sure that it does attract investors. Rajiv, moving on to you. In order to facilitate further strategic disinvestments, Finance Bill 2023 proposes to amend the definition of strategic disinvestment in Section 72A of the Income Tax Act. So what are your thoughts on this move?
So, Gautam, in fact, I would like Vivek to answer that. He's a better person to answer that question. But I do want to add a
Okay.
little bit to this ease of doing business and decriminalization.
Hmm.
Remember, the ease of doing business is not just about how many forms I need to fill and how long does it take for me to get permit A or license B and approval C. It's also about the experience of the taxpayer vis-a-vis the tax authorities. In many cases, these what the law deems criminal act often becomes a source of enhanced friction between the tax department and the taxpayer. So, decriminalization of these powers also facilitates the experience that a taxpayer goes through. Remember, in tax laws, not just in India but around the world, there is always a difference between what is an honest dispute. I interpret a law in a certain way, and you interpret a law in a certain way, and we can have a difference of opinion. Not every difference of opinion is a matter of evasion. Evasion is a completely different aspect. But in India, in the tax laws, this distinction is not often, in fact, it is rarely clear. Only the courts look at this distinction, but the interpretation of the department and interpretation of the taxpayer, if it results in an honest dispute, that should not be treated as a crime and should not be dealt with as evasion. That's what I wanted to add to the point that you were discussing with Vivek.
Absolutely. Sense and sense required when it comes to treating these matters. But meanwhile, Vivek, coming to you for your thoughts on this change of definition of strategic disinvestment that we are seeing in Section 72A of the ITA. Your thoughts?
See, the point is the government has very clearly outlined a plan for strategic disinvestments. It's not something that's happening just this year. It's a journey that we are on. And for that journey to be successful, it's imperative that the government gets the best price for the asset. The change that's been made in 72A effectively means that past losses of any entity which undergoes strategic disinvestment can still continue to be carried forward in the hands of the new buyer, even though there may be a substantial change of shareholding by the government. So even if the government completely disinvests or disinvests more than 51%, the losses that would otherwise have been ordinarily lost or lapsed will continue. What this essentially means economically is when a bidder is bidding for the asset, he can price in the value of this deferred tax asset that comes in from these losses, and therefore the government will be able to extract a higher price on the strategic disinvestment, effectively assisting strategic disinvestment. And the fact that so what the government is effectively saying is we don't really care for the tax revenue that will come to us over a period of time. We want the assets to go in the hands of the buyer pretty much as is, with all the attributes that are available with the company, and we want to extract the maximum price when we are ceding control and selling out strategically. That's the idea and logic of the disinvestment, and I think it makes preeminent sense. In the past, the government has made similar amendments in the budget in the context of specific disinvestments. And now they've come at this in the concept of saying any strategic disinvestment by the government will be entitled to this benefit, and therefore the price that the government receives will be to that extent higher.
All right, Vivek, but is there also a sort of a holding pattern right now for the government, especially when it comes to disinvestment? Because its mention is in the appendix and not in the main budget as per my reading of it. So your thoughts?
I think the government now has a very well-developed plan. Under the current disinvestment secretary, the government has a very well-developed plan where they've identified what assets need to go and what assets need to go under what head of disinvestment. So some assets will be disinvested through minority stakes. Some assets will be disinvested through the public issue route. And some assets will be disinvested through the strategic disinvestment route. The strategic disinvestment route will be the route where the government gives up control. It's the third category of disinvestment, which also gives the government the entire control premium on the asset, where this provision will be relevant and material. I do not see, by mere placement, I do not see, or I do not want to surmise that the government has X focus or Y focus on this. I think the government now has a very clear path on how it looks at disinvestments within the three categories. And of course, there's a fourth category of asset monetization, but that's a separate category. But in the basic three categories, the government has a very clear path, and it is to assist the third of those three categories that the government has come up with this. So I view this as positive, and I do not ascribe any lack of intent or any less intent on this third bucket, really.
Rajiv, coming to you, the government also announced that there would be no capital gains tax if physical gold is converted to an electronic gold receipt or EGR and vice versa. So, how will this encourage buying of electronic gold, and what impact do you see this move having going forward?
So, Gautam, as you can imagine, in India, we all and historically and culturally have a asset class which is gold, which every household, regardless of the economic strata of the Indian, whatever be the economic strata, there is always some investment in gold. But historically, it has always been this a so-called unproductive asset in household. It remains in people's vaults, and it only gets used as in a private capacity. And there have been several attempts to convert this into an asset class which comes out in the market as an asset class. We've had seen situations in the past where electronic bonds or gold bonds were issued. I don't think it has in any way change the habits and thinking of Indians as far as gold is concerned. They still see it something that they need to possess, touch, feel, wear, whatever. This electronic gold bond was a scheme that was started in the budget of 21-22. SEBI is, appointed the regulator. It is a fresh attempt to try and convert this into a productive asset class, and it is a experiment that of course, will take time to mature, but it can be a game changer. What has been done in this budget is, there is this process of converting a physical asset that you hold, converting into a class, into an electronic form of bond. And there's always a question as to when you convert the value of gold that you have into an electronic bond, does it amount to transfer? And if it amounts to transfer, does it result in taxes? That has been the issue. What this time the budget has clarified that, or has created a provision in law that when the authorized vault holder converts and creates a class of asset which is electronic bond, that would not be considered a transfer and therefore not liable to tax. And this is a facilitation measure, but it was an important step to create. Otherwise, at the very first step, it was raising issues. And if that became a taxable event, you can imagine it will have no chance of this asset class or this maturing into anything meaningful. So I think it is one of the enabling or enabler that has been created. Very, very important. But the way this electronic bond will evolve, will it change the way Indians personally look at gold? I think that is yet to be seen. But as an idea, as an experiment, I think it is great.
All right. It's a start, and maybe in the future, all that is gold may not necessarily glitter. Vivek, coming to you in terms of concerns. Now, the income tax connotation of a fair value has been made more pervasive under Section 56. So, what impact will it have on venture capital and PE funds, and any other implications that you see?
So let me explain the change briefly. There's a specific subsection within Section 56 which was hitherto applicable only to residents. That has been made applicable now to non-residents as well. This section is a section that gets attracted when an Indian company raises primary money. And because now it has been made applicable to non-residents, the vast majority of venture capital and private equity funds, which are structured mostly either as AIFs or as non-resident investment vehicles, they become directly subject to the non-resident private equity funds become directly subject to the section. What it essentially means, Gautam, is that all your traditional constructs of a VC deal, which would have conversion milestones, which would have ratchets, which would have preferences, they become slightly more difficult to structure because you now have a fair value under FEMA, and you now also have additionally a fair value in the context of the Indian Income Tax Act under Section 56. So the more fair values you keep inserting as constraints into an equation, all of the normal commercial terms that an Indian company and its founders are happy to concede and that a VC uses globally become more difficult to administer and manage. One additional point that I would like to make on this is I do not think I've seen any other law around the world which contains these artificial restrictions. Basically, there is the whole concept of transfer pricing that exists in terms of transactions between related parties or transactions between unrelated parties which are influenced by underlying transactions between related parties. But the general assumption is when institutional money is coming in between unrelated parties, that transaction must be at arm's length unless specific evidence can be adduced to the fact that the transaction was not an arm's length. To that end, I find that subjecting every such transaction to the rigors of this income tax fair value is perhaps not required, not necessary, and therefore I say that the income tax connotation of fair value has been made more pervasive than perhaps it ought to be.
All right, let's expand the conversation to hear from Rajiv. Your thoughts on some top concerns when it comes to announcements made in Budget 23 or 2023 or not. I believe global minimum tax rules didn't find a mention anywhere.
Yes, so the global tax rules did not find mention, as you're right, but that's a debate. That's a global debate. I think that thought is to fully mature in many parts of the world, but it is a debate that must continue. I think a mention of that to say, what's happening in that area and some insight into what's the approach would have certainly helped because in the taxpaying community, that's a big deal at this point in time. But it is conspicuous by its absence. You're right. I mean, just to add the point that Vivek was making, you know, India already has in the tax rules formal GAR rules. So if you do believe a particular transaction has, been done for reasons other than pure arm's length, there are already rules to address those issues. But as Vivek said, to make every unrelated party transaction without regard to the global stature of the investors, that's going to hurt. And if an Indian company is able to get premium because India is on the rise, are we saying that we will, come in the way of that premium? So the logic of this expansion of the valuation that is being inserted, at least I strongly believe that that needs to be tweaked and that needs to be relooked at. So if at all in this budget, if there were certain things that are area of concern, this certainly is one of those. And also, no mention of PLI, although we heard subsequently after the budget that there might be new schemes. But I think PLI, which is a fabulous scheme and has been a highly successful scheme and has great promise, no mention in this budget on the PLI was also something that was a little bit disappointing for me. So, other than this Section 56, which is, I believe, a major negative, I think I would also only comment on we could have heard a few things about certain important aspects which weren't there.
All right, Vivek, your thoughts on this? Any areas which were significantly left out, and your top concerns from this budget? A quick point of view from you.
Okay, so look, overall, I think the budget was very good. Lots could have been done, which could have been, which would have upset the apple cart. Stability, continuity, as you said on the top of the show, I think hugely positive. The fact that there were personal tax cuts to the extent that there were, I think hugely positive again. The fact that the 43% rate for the top 1% goes down to 39%, again positive. I think it keeps a large part of the investing universe back in India without causing them to have to move to Singapore or UAE. Two other things that we could have seen, and look, this is all work in progress, so hopefully we will see and hear it as the year goes by. I am a big fan personally of hybrid securities. I think there's been a debate, and this has been going on a long time, 5-7 years, where even the RBI has said that in certain cases, hybrid securities must be permitted. Today, as you know, the Indian law allows only either pure debt or pure equity, largely. I believe that if today the equity flows on the private equity venture capital side are, let's say, between 60 and 70 billion annually, if we were to open up hybrid securities, we are probably opening up another 25 to 30 billion dollars of capital coming into India, which then becomes huge in the context of the global competitiveness for capital and also in the context of how capital hungry we are as a nation. So hybrid securities is one. Second, I would say the fact of the government took a very good step last budget from the Damodaran Committee for Venture Capital and Private Equity Investments. We believe the recommendations went through to the government latter part of maybe even December of last year. Maybe less time to process them, but a lot of the regulatory part of that, I think, we would hope to see implemented during the year, which does not require a finance bill, and the parts that require a finance bill can then come in later. Some mention of that would have been good to hear, but obviously we understand that that will need to be processed, and perhaps during the year one would see some action on that too. So these would be my two big points. As I said, I don't see any huge negative. Yes, Section 56 and its overall concept and connotation and its expansion over the last 5 years, and the one thing that has happened this year is negative. But I think that's part of a larger debate on the need for Section 56 itself. Otherwise, I would say, in summary, a sound budget indicating consistency of policy. So largely positive.
All right. Any other measures required to accelerate the M&A space, which you felt the government would have been, best placed to do it right now? And what long-standing demands on the industry do you think still remain unaddressed in this space?
Look, in most cases, and we've been in this business long enough to see that the industry would always want more and more. And frankly, everything is evolving, right? At this point in time, was there something that we were absolutely dying for which has not happened? Perhaps not. Can other things be done to propel M&A in the economy? Can other things be done to make India more competitive from a capital attractiveness standpoint? Certainly, yes. We've spoken about 2 or 3 of them on the show already. If, for example, reverse flips, cross-border mergers, extension to sovereign pension funds for infrastructure investments, if some of those things could have happened this budget, it would have been even more positive. Having said that, is it fatal? No. Having said that, does this mean that the door to all of that is shut? Again, no. I would imagine that if we follow consistency of policy and continue our reforms over a period of time, and I would say in the short term, one would see most of these things find their way into the statute in one way or the other.
Vivek, just to add, the budget 2023-24 has also brought about distributions made by real estate investment trust and infrastructure investment trusts in the form of return on capital taxable in the hands of unit holders. So what's your view on this measure?
Actually, if I see it very fundamentally, this is correcting an anomaly. Today, you had flows in the form of dividend, you had flows in the form of interest, and you had this flow in the form of repayment of capital, which was not getting taxed. And dividends and interest had their own tax mechanism. So in a sense, it's government correcting an anomaly. The way it's been done, though, is perhaps not entirely correct. It has been put in the chapter for income from other sources, so it's not capital gains. It does not enjoy cost offsets unless the underlying unit is redeemed. It also, and more than that, it disturbs established economics for an asset class that is still in its infancy. REITs and InvITs in India are still in their infancy. I would only have hoped, I would have hoped to see this change happen either later, or I would have hoped to see this change happen in a way which was, let's say, which did not give rise to the anomalies in the way that this change has been done. But I cannot find conceptual dissonance with the fact that all of these flows ought to be taxed in some way or the other. Now, would I have taxed it the same way? Perhaps not. Has this been taxed harshly? Yes. But will the government listen to the concerns of REIT InvIT holders and REIT InvIT investors? Perhaps yes too. It has been my experience that as this regulation has been in its infancy, various regulators, SEBI, others, have been very, very, have given us a good ear in terms of listening to the problems and solving for the problems. So I'm hopeful that the problem will be solved for, but the conceptual problem is not in the way that not the fact that the tax has come, but in the way that this tax has come.
On that note, it's time to wrap up our special presentation titled KPMG and CNBC-TV18 present Budget 2023, the fine print. Rajiv, Vivek, thank you so much for joining us on this talk and sharing with us your insights. And of course, thank you to our viewers for tuning in. Till next time, this is your host, Gautam Srinivasan, signing off. Have a great day.
KPMG and CNBC-TV18 present Budget 2023, the fine print. Focus, ideate, innovate, enable.